Ranging markets, also known as sideways markets, occur when the price of an asset moves within a defined support and resistance level, without establishing a strong upward or downward trend, making them ideal for options traders who understand strategies designed to profit from limited price movement. Unlike trending markets where buying calls or puts may be the preferred approach, ranging markets require strategies that benefit from stable prices, declining volatility, or predictable price swings within a narrow range. One of the most popular strategies for these conditions is the Iron Condor, which involves selling an out-of-the-money call spread and an out-of-the-money put spread simultaneously. This strategy allows traders to collect premium while expecting the underlying asset to remain between the two short strike prices until expiration. If the asset stays within the expected range, the trader keeps most or all of the premium received, making the Iron Condor an attractive choice for experienced traders seeking consistent income. Another effective strategy is the short strangle, where traders sell both an out-of-the-money call and an out-of-the-money put, anticipating that the market will remain within a specific range. Although this strategy offers higher premium income than an Iron Condor, it also carries significantly greater risk because losses can become substantial if the asset makes a strong move in either direction. Traders who prefer defined risk often choose the Iron Butterfly, which combines the sale of an at-the-money call and put with protective long options at higher and lower strike prices. This approach generates higher premiums than an Iron Condor, but requires the underlying asset to stay closer to the center strike for maximum profitability. Another commonly used strategy is the covered call, particularly for investors who already own shares of a stock they believe will trade sideways. By selling call options against their stock holdings, investors earn premium income while potentially selling their shares at a predetermined price if the stock rises modestly. Similarly, the cash-secured put strategy enables traders to collect option premiums while being prepared to purchase a stock at a lower price if assigned, making it suitable when the market is expected to remain stable or experience only minor declines. Success with these strategies depends heavily on selecting appropriate strike prices, monitoring implied volatility, and managing position size carefully. Many traders prefer initiating premium selling strategies when implied volatility is relatively high because option prices are more expensive, increasing the income received from selling contracts. As volatility decreases, option values often decline, allowing traders to buy back positions at lower prices or let them expire worthless. Effective risk management remains essential because unexpected news events, earnings announcements, economic reports, or geopolitical developments can quickly transform a ranging market into a strongly trending one, resulting in significant losses for traders who are unprepared. Setting predefined exit rules, using position sizing that aligns with overall portfolio risk, avoiding excessive leverage, and diversifying across multiple positions can help reduce potential losses. Additionally, technical analysis tools such as support and resistance levels, Bollinger Bands, the Relative Strength Index, RSI, and Average True Range, ATR, can help identify genuine ranging conditions before entering a trade. Ultimately, the best option strategies for ranging markets are those that align with limited price movement, capitalize on time decay, and incorporate disciplined risk management, enabling traders to generate consistent returns while minimizing exposure to unexpected market breakouts.